Joining us now is Victoria Greene of Squared Private Wealth and Matthew Miskin of Hancock Investment Management. Guys, happy early Thanksgiving. Victoria, can we go higher? Must we go lower from here? Awfully close to 4,600.
I think we're going to kind of rally around this area. 4,600, I see that as a ceiling. I don't see us pushing up to the 4,800s or new all-time highs before the end of the year. I think the stage of rally came a little bit early to us. I just see yield not being able to back up another 50 basis points to support a larger year-end rally. So moderately positive. I see a lot more churn, though, up and down and volatility as we head into year-end, because it was just a kind of a mixed week. Today even was a mixed trading day. You know, had a little bit of negative shock on the unemployment reports, and then suddenly everybody remembered it's just rally all the time, and we got a nice little rally into market close, basically not on good data, not on good earnings, just because the market just sees its risk on.
Okay, so Matthew, do investors just sit on their hands then now? I mean, it's going to be time for portfolio rebalancing before long.
Yeah, we're looking to move into the higher quality parts of the market. So we're really screening on things like great balance sheets, high return on equity, good profit margins. That is placing us more into the technology space. We'd also consider healthcare going into next year. It's been a sector that's left behind, really struggled earnings-wise based on high comps, but we think that could be a comeback story into 2024. But we would shift portfolios more into quality, reduce smaller cap exposure after this nice little pop, and rotate into higher quality mid and large cap stocks.
Victoria, is the soft landing narrative still in place here? I asked that with oil down, yields down, jobless claims today, the latest data that's, we'll call it firm. Can we claim that yet?
Yeah, so I think that today it's just a little bit more of the narrative on the Fed. I feel like the Fed and yields have moved so much of this market recently. I do fear that the Fed is going to come out hawkish over the next couple of months to try to roll back this 100 basis points cuts priced in. Obviously, during the meeting minutes, they didn't talk about cuts. And so you have to look at this and think the Fed, the most dangerous periods of this market is where the Fed is trying to do one thing, but expectations are another. And so when those two things do not align, Fed action versus expectations, that's when we get those huge market dislocations. So I feel like the Fed over the next few months is just going to pound the table of we don't want to cut rates, we don't want to cut rates, we want to be higher for longer. And that may see yields back up a little bit more as people brace in. Is 100 basis points the right way that 2024 is going to go? I don't think they're going to hike again. I think they lose all credibility if they do, but I think they're going to try to hold firm for as long as possible. And that might be a little uncomfortable with some of the rhetoric to get us there.
Matthew, you would argue that we've seen a pull forward of earnings growth from Q4 to Q3. I mean, look no further than Deere results this morning, with that stock finishing lower as it released a forecast that was below street expectations, despite beating on the top and bottom lines for last quarter. When you talk about a pull forward, do we know just how acute that's been, and how does that set us up from an earnings perspective going into not only the end of the year but 2024?
Yeah, I think as Victoria highlighted, Santa came a bit early, and I think that is kind of the story. I know for us personally at our household, we did a lot of the shopping beforehand. Black Friday was a lot of the sales, a lot of the incentives to go shopping have actually been brought forward. And I think we got some of that in Q3. Analysts were way underneath where earnings ended up coming in. So earnings growth came in at about 4%. In Q3. It's been an amazing quarter. Only three sectors are negative on earnings. The rest are positive. I mean, some are blowing out earnings by over 10%. The thing is that the analyst community, when they look at these results, are saying that's great, but it's going to be hard for you to do that into Q4. And they've basically chopped down Q4 earnings estimates from 8% to 2%. So while we got a great Q3, what they're saying is it's going to be hard to keep this momentum into the next quarter. Slow growth is okay, actually, for this market. We want not blowout growth. I think that's actually a decent thing. But if the pendulum shifts a little bit too far the other way from tighter monetary policy, some cracks in the labor market, we could be into weaker earnings into 2024. To us, again, focusing on that quality factor is key to mitigate the margin pressure we're likely to see into next year.